I have created this PowerPoint with some information that is related to the Gen Inc. Part A assignment. Much of what you are going to see in this PowerPoint is coming from the case study Gen Inc. Part A, and hopefully my conversation may provide you with some guidance, some understanding as you are looking at Gen Inc. Part A. So the overall objective of Gen Inc. Part A, one of the key learnings, as you may have seen in the Word document, is to get a refresher on income statement. Much of what we are doing right now, you have been exposed to in your MBA 633 accounting, so this is a refresher. The two textbooks that you have, you can find material in there. For example, in the Corporate Finance CFIN book, I believe Chapter 2 has material on income statement, balance sheet, and that will give you a refresher. So, referencing to the case study, what you have on this particular chart in the PowerPoint, on the left side is the organizational structure. Now, this particular organizational structure is I have created for this particular case study. Obviously, depending on the organization where you work, depending on the industry that you are in, the organizational structure may be different. For example, your company may or may not have engineering function and may have other activity. So it really depends on the industry, depends on the function. But overall, there are going to be key organizational boxes that are run by the head of those departments. And collectively, the whole organization in totality obviously is responsible for running the company, and hence responsible for managing the profitability, or the income statement. So on the right, what you see is an income statement. And as you may recall from your managerial accounting, MBA 633, that it starts out with sales and ends with net income. And the components include cost of goods sold, which is your typically cost that is directly related to producing the product or providing the services. Sometimes you may find, for example, in some websites or some annual reports, some company may call this cost of revenue. And typically companies that produce product, like the auto companies or the manufacturing companies, they will typically call it cost of goods sold, because goods is considered as more tangible. Whereas companies, for example, financial industry, the banking, they're not really producing anything. Obviously, they're providing a banking service or insurance service. They might call it cost of revenue. But either way, it is a cost that is typically directly related for the particular product. So we subtract the cost of goods sold from sales, and we see how much money we have left. So in this case, we have $13 million left, and it's typically called a gross margin. Margin in the sense that between the cost to provide the service or produce the service, which is $27 million in sales, we are left with $13 million. And the reason it is typically called gross, sometimes it is called contribution margin, is because obviously there are other costs that we still have to cover before we get to the net income. In most income statements at the consolidated level, you will find a bucket called SG&A. And SG&A includes, stands for Selling General Administration. And that would include many of the activities that are shown on the left. And I will talk about some of those, what goes in each of those boxes. It is articulated in the case study, so you can read it, but I am going to touch on it in this PowerPoint. Then you got research and development, R&D, typically your engineering budget, if the company has, engineering. In this case study, they do. Then you end up with a line item that is called EBIT, or earnings before interest and taxes, which means how much do we have left now after we have paid for SG&A and R&D. So to get to 7230 number, which is the EBIT number, we are taking the gross margin, which is what we had left over after we spend money for cost of goods sold. We subtract from it SG&A, which is $3.67 million, subtract $2.1 million for R&D, and we are left with 7230, $7.23 million or EBIT. The next expense that will come along is going to be our interest expense. So if we have a debt, we will be paying interest on it. And so in this example, it is $210,000. And then you get to what is called earnings before taxes, EBT. Sometimes, as you may come across either in textbooks or at work, the word earnings and profit are synonymous in the sense that people will say profit before taxes or they will say earnings before taxes. They basically mean the same thing. So in this example, earnings before taxes or profit before taxes is $7.02 million, and then they pay taxes of $1.755 million, and what they're left over is a net income. A profit margin is a ratio of how much net income are they generating for every dollar of sales. So that would be 5.265 or $5.265 million divided by the total sales, which is 40 million, which comes out to be 13.16%. And this is typically very, very useful when you want to compare, company A with company B, because you can be comparing a company that be much bigger. For example, let's say a similar company, same industry, was $80 million. So obviously you cannot compare the absolute value of net income. An $80 million company probably will make more profit. But in terms of how effective they are, what you want to do is to see how many dollars of a net income they create per dollars of sales. So this way you can normalize it, to make the comparison. So SG&A in terms of organizationally, typically in most companies you're going to find items like sales and marketing, finance, accounting, human resources, and there could be other G&A functions depending on the company. That would include legal, legal costs, etc. And typically also general manager, the person who runs the organization, is also considered as the general administration, so that would be part of it. Most times you're going to find operations is separate in terms of they are more tied to the cost of goods sold, and the organization will typically include manufacturing, purchasing, and quality type functions. And and companies may have engineering, and that would be considered research and development kind of a cost. Now, these are cut and paste from the Gen case study. So I will just quickly walk you through some of the material. So the operations department in our case study is run by Richard. And the overall role of an operation department is to produce and deliver quality hardware at the target cost and on-time delivery. So, Richard in this case running the operations, that is his, key objectives. Now, one of the financial objectives of operations of this department is to provide strong gross margin. Remember, in the prior slide, we talked about from sales, we subtract cost of goods sold, and we're left with gross margin, the money we need to continue to pay, and hopefully we're left with something for net income. So if you're running an operations, one of your key objectives is to drive the gross margins higher. And the gross margin is really sales minus manufacturing operations cost, or typically called cost of goods sold. Now, within the manufacturing operations cost, the costs that are typically included are direct labor. These are directly related to producing and inspecting products in the factory. Now, obviously, these costs could vary with volume and thus considered as a variable cost. So anyways, so these are the items that are listed on this slide are typically you're going to find in most companies under the operations functions. And so the head of the department will be responsible for managing these types of costs. In the sales and marketing function, obviously the group that is responsible for, calling people, selling, doing market analysis to see what the market opportunity and so on. In this example, a case study, this department is run by Julie. And so Julie's responsible, obviously, is not only manage the, selling and and marketing, but she also obviously has to manage her budget for the department. That would include salary and wages for salespeople and marketing people, and any overhead costs associated with running the sales and marketing department. And typically, question pops up sometimes: are these fixed costs or variable costs? In the short term, I will describe it as maybe 6 months, or less than a year. These are typically fixed in the sense we typically, if the volume goes up and down, typically these costs do not move with the quantity that is sold. So if you want to do a break-even analysis, then what you want to do is you can safely assume that the sales and marketing function can be considered as a fixed cost. Now, obviously, any cost in the company, as you would expect, is variable in the sense that somebody can completely outsource sales department or marketing function. So in the long run, it could be variable, but typically in the short run, let's say less than a year, from a calculation perspective, one can safely assume for the short term that functions like SG&A, like sales and marketing, can be considered as a fixed cost. Another function typically going to find in SG&A is finance and accounting, and obviously finance and accounting job is to be managing the overall financial functions, the accounting, doing the taxing, budgeting, etc., and also guiding the other departmental head to be able to make sure that the overall business functions effectively in terms of finance and accounting. And also they are the scorekeeper of how the overall department budgets are doing, and also how the company is doing in terms of performing their income statement and balance sheet. Another function typically you're going to find in SG&A is the human resource department. In this example is run by Andy. And the overall role is to provide HR functions, for example, hiring, onboarding, managing performance appraisal, etc. And they're typically an SG&A function. And here again, for the short term, just like other SG&A function, be finance and accounting or marketing and sales, human resource function can be assumed fixed in the short period. Research and development, in this case, example is run by Janet, and obviously the overall role for engineering function is to be able to design, develop things that eventually can become produced by the factory, and that they will sell it. And so the job of engineering department director is to obviously do the creative, innovative work of design development. But at the same time, Janet also has the responsibility to make sure that she manages her department with the budget that has been provided to her. Because if she does not, if her budget's overrun, obviously the research and department costs in the income statement would go up, and then would drive the net income down, and they will not achieve their financial objectives. General manager office, Sarah is in the office with her assistant. Obviously, that would include the cost to run the offices, anything that are associated with that. And again, this will also be considered as the SG&A, and typically it should be considered as a fixed cost. There could be other G&A functions in the department. Sometimes some companies will put it separately, in a different budget. Sometimes they may, call it miscellaneous. It could be like budgeting for, events, budgeting for holiday parties, special awards, etc. And again, typically they're also considered SG&A because they're administrative functions, so they're included in the SG&A account. So what the organizations will do is to look at the types of costs that are related on the left side, and which is part of the assignment that you're going to do for Gen Inc. A, is to fill this out based on the information provided in the case study. Is for each of these category, how much direct labor they have, how much money they have budgeted for that particular department, salary and wages, how much money they have budgeted for raw material, etc., etc. For example, sales and marketing, the salary and wages is $2 million, and they have overhead cost of $200,000, so the total budget is $2.2 million. Now, one quick comment, I kind of touched on it, fixed and variable. So I will give you the punchline, which is in the blue on the right under the smiley face. From a classroom perspective, from a textbook perspective, for an analysis perspective, typically a basic model, and again for this class you can use it, is to assume that the cost of goods sold as a variable cost, which means it moves with the quantity, and the other costs, which is SG&A, engineering, etc., to be fixed. So that is a safe assumption for the analysis. On the left side, I do want to provide some more real life experience, real life things that happen at work that you may come across. So if somebody, where you work is talking to you, and you basically take up, provide a more simpler approach, you should be aware of some of the nuances I want to share with you on the left side. The obvious one for variable, the procured material is always considered as variable. Obviously, if you're making, let's say if you're making furniture, let's say you're making tables and chairs. So the lumber you are going to buy, and the paint and the nails and whatever you need to make the furniture, obviously is going to be variable, because more furniture you're going to make, more procurement material you have to buy. Similarly, direct labor is also considered as production. I mean, as it directly related to the quantity, because more tables and chairs we're gonna make for a furniture business, more direct labor I need to make them. Any overhead related costs, depending on the size of the company, they may try to break it out between fixed and variable. For example, anything that is typically considered indirect hourly. An example of indirect hourly will be somebody that is responsible for moving the material from the storage to the factory and back. One can consider that if you are going to make less production, you will need less people to move things around. So sometimes some indirect hourly may be considered as variable. Energy for running the machines can be considered as variable. Obviously, more you run the machines, if you have more products to make, more you're going to run the machines. So quantity will drive the energy cost. Some of the supplies could be considered variable, like cutting tools, grinding wheels, etc. Any supplies or expenses that can be variable, for example, office supplies, travel, those are the things that you can vary it with the amount of business you have. So again, for this class, for the classroom perspective, we'll take a simpler approach. We'll assume cost of goods sold is variable, and the other pieces are fixed. But also remember, my last comment on the bottom, that in the long run, in any business, everything is a variable. In the short run, within a year, some of these things may not be easy to get rid of. Like somebody can close the factories. You can outsource the activity, etc., etc.